Welcome to FX Options University, recorded live at the International Securities Exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
And obviously the Canadian dollar plays the same role. The Canadian dollar a little bit less because of its component of U.S. trade is still so large, and it's kind of a little bit tied to North America and the U.S. But in general, it is a commodities currency in a big way. So that would be another choice. The secondary choice in this environment, especially in the environment we're in, is the euro. Now, the euro, in terms of commodities, may have nothing to do, it has nothing to do with that. But what's going on in terms of the cycle, the cyclical driver of this growth, is the choice of using the U.S. dollar as the implicit weak dollar. It's an implicit weak dollar policy. The government has made a choice to create as many dollars out there as it can in order to fund global growth. And if that's the case, what is the flip side of the U.S. dollar? The flip side generally is the euro. It's the other competing world currency out there relative to the dollar. Not a great competition, but on a relative basis, it's the other biggest one out there. So when you see a lot of dollars going offshore from a capital flow standpoint, when people get afraid of what's going on in the U.S. dollar, they're going to tend to own more euro because of the relative depth of their capital markets. I won't go into this too much, but you can look this up. If you just Google Triffin's dilemma on the web, I think it's something, it's a good thing to have in mind if you haven't heard of this before, or at least to understand. It's the idea that once the U.S. dollar took over the role of gold in the global financial system, the U.S. government is basically forced to run these current account deficits and these imbalances because the dollar is the global funding currency now. If dollar credit out there shrunk, as it did during the credit crunch, you see real problems around the world. So the U.S. government, being the world reserve currency and being that the dollar's taken over that role of gold as that role of gold, kind of forces the U.S. into these deficit patterns. So we're kind of fighting a little bit against the trend all the time in the U.S. dollar. So when people say, oh, we need to improve our current account deficit, take it back to zero, make it positive, keep in mind that the U.S. current account deficit is part and parcel to the dollars going out around the world to fund growth. This will change as economies around the world get bigger and they develop their own depth in capital markets, and the U.S. world reserve currency status will definitely start to recede, and other currencies will start to take a bigger role as trade in capital markets, which I think is really the key, start to develop in these other areas. And people say, well, that's a terrible thing. The U.S. is going to start to lose its reserve status. It won't happen overnight, 20, 30 years if it happens at all. But the reality is the U.S., again, is forced to be a little bit open in terms of its funding for the globe, which forces some irresponsibility in general because of that status. So as it starts to lose it and the dollar isn't needed as the global funding currency in such a big way, it may actually start to be a little bit more beneficial for the dollar. And who knows, it may even be more beneficial for the U.S. economy if we don't have to sacrifice the dollar to keep global asset markets afloat at times like this. The other environment, again, risk appetite, but the U.S. is the growth driver here. And again, I wrote on here, it does happen. Most people just don't believe that. But I think the best period in which you can see that is the 1990s period. The growth driver was this massive run into the NASDAQ so people could get positioned into the tech area going forward. And because of that, it tended to pull in a lot of foreign direct investment back into the U.S. And foreign direct investment tends to be long-term growth drivers and tends to be money that stays here, and it helped drive that 10-year bull market in the dollar. So that's where an example of U.S. Centric as the growth driver. You want to be short against, I think the major basket you want to be short against is what I refer to as the savings block currencies, or you could say the euro block currencies. Those are the ones that I think you're going to see them as money fades because major portfolio flows will come back out of this area and into the U.S. In a bigger way. And the U.S. won't have the competition of these guys when it's used as a funding currency to fund Asia. I hope that makes some sense. So I think the key currencies, if we see this, that will be hit with euro, Swiss, and the pound. What is interesting, you saw the euro, Swiss, and pound get hit pretty hard on this last non-farm payroll report, and I think you saw a mini glimpse of this. And again, I'm not saying the U.S. is staged for a massive rebound, but you saw a mini glimpse. That surprise growth, it wasn't even growth, but that surprise less bad news than expected in U.S. jobs, the euro, Swiss, and the pound were the ones that have gotten hit the hardest here because of that, the U.S. growth surprise. Think of it this way. Commodity currencies like growth in general. So if the U.S. grows and grows faster than the Eurozone, they're the ones that are going to get hit the hardest. In the commodity currencies, with the U.S. back in the ball game, their economies will tend to do fairly well. So I think you'll see a short-term impact on the commodity currencies if we see a U.S. growth surprise, and it would be a growth surprise. But eventually, I think you'll see the commodity currencies tend to go from neutral to positive, especially against this block. So keep that in mind. Growth in the U.S. is still good for commodity currencies. Growth in China is good for commodity currencies. So who's stuck in the middle when these two blocks, the U.S., say the U.S. dollar or North American block, and the commodity block's doing well? Who's stuck in the middle? Where does the money have to flow out of? It flows out of the savings block currency, which basically are the older line euro currencies. So hopefully that makes some sense, and I think it's a decent piece of analysis there that at least that we've worked on. Again, we haven't been back in an environment to test it for a while, but maybe we will someday, hopefully. Okay, moving into risk aversion environment. This is when people are scared, taking money offshore. Obviously, we've seen that happen. This was the credit crunch. Risk aversion, the growth opportunities were in Asia and China. Credit crunch hit. What currency got hit the hardest? We wanted to be short against the U.S. dollar, the commodity block. Australian dollar got killed. New Zealand dollar got killed. Real backed up in a big way. Canadian dollar got slammed. The euro also got hit in this environment, the euro being the flip side of this whole Triffin's dilemma and implicit weak dollar policy. When money rushed back into the U.S., the euro got hit pretty hard on a secondary basis, but not as hard as the Australian dollar, the key risk appetite currency. So we've been through that and seen that example. Risk aversion with the U.S. growth driver. I mentioned this a little bit on that first slide. Currencies you want to be short against the U.S. dollar. Again, if we see the U.S. growth driver and risk aversion in the world, in general, those that are benefiting from growth are going to get hit the hardest. Australian dollar, the commodities block. Remember, again, the U.S. is growing. It tends to benefit commodity currencies. If we see risk aversion, it's going to tend to hit the commodity currencies. This analysis assumes that this risk aversion isn't U.S.-centric in a very, very big way, that triple whammy situation, which we had the U.S. stock market crash, and people tended to run out of U.S.-based assets and into euro, okay? Making the point, even though there's risk aversion and even though it's a U.S., and because it's U.S.-centric growth, in general, during major recessions, major global recessions in normalized environments, we've seen the U.S., the world reserve currency, do well. It's just natural. Think of a global recession and think of the economy, the global economy, with the U.S. at the center. It still is a U.S.-centric finance global economy. That's changing, and it'll start to change faster, I think, as Asia develops its capital markets, as Latin America develops its capital markets. This will change. But at the moment, that's still the general framework. The U.S. is at the center of this, the core of global finance. The Fed is the de facto central bank. So you have the center, and everything outward, especially in the emerging markets, considered the periphery. So when you have a recession in the global economy, just think of the money as just starts to flow back to the center in general. The money from the world reserve currency tends to flow back to the center because recessions represent risk. They represent people bringing money back into the deepest capital markets. So in general, during a recessionary period, the U.S. dollar tends to do well. And even if the U.S. is growth-centric and there's a risk aversion period, we think the U.S. dollar will continue to do well in that environment. And I hope that makes sense.
Thank you for participating in this week's session. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.